Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 362 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including a lesson in leverage with another hedge fund blow-up, current mortgage rates, an update on the SpaceX IPO, and what credit spreads are saying about this market. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. It's another solo show with me today while Matt is out, but there's no shortage of things to discuss this week, so we will hop right in. And as always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on August 5th. S&P 500 index is up 3.2% for the month of August and up 12.8% for the year. NASDAQ Composite Index up 4% for the month and up 13.4% for the year. The Dow Jones Industrial Average up 3.6% for the month and up 13% for the year. The Russell 2000 Small Cap Index up 1.8% for the month and 21% for the year. The Vanguard All World ex-US Fund up 2.1% for the month and 14.9% for the year. So stocks are off to a hot start so far in August, just about 3 trading days into the new month. Moving on to Treasury yields, the 2-year sitting at 4.2%, the 10-year at 4.6%, and the 30-year at 5.2%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So moving into big headlines and current events from this past week, one of the more interesting stories in the financial markets last week wasn't your typical talk about inflation or interest rates or earnings, since we're in the middle of earnings season. It was about what happens when a great investment idea meets too much leverage. And this is a story that we continue to see over and over again. I think, a couple of years ago in 2021, another hedge fund blew up because they were using too much leverage and didn't have their risk in check. So I'm not sure why this continues to happen and people don't learn from it, but I just wanted to talk about it because this was in the news cycle pretty heavily in our industry last week. So basically, a guy by the name of Leopold Aschenbrenner, who is a former OpenAI researcher, launched an AI-focused hedge fund called Situational Awareness. So his investment thesis was pretty straightforward. Artificial intelligence is going to require an enormous amount of computing power, chips, data centers, and electricity. So he built a portfolio centered around companies positioned to benefit from that trend, like many other money managers have over the past couple of years. And for a while, it was working incredibly well. Through the end of June of this year, the fund reportedly gained more than 400%, making it one of the hottest performing hedge funds in the world. But then we came to July. And the problem wasn't necessarily that the AI thesis suddenly fell apart, although a lot of the AI-focused names did pull back, like semiconductors, for example, pulled back, depending on the name or the ETF that you're using, anywhere from 20 to 50% just in the month of July alone, because it's had this exponential rise so far year to date. But the fund reportedly used a significant amount of borrowed money, known as leverage, to amplify its returns. So you can think of leverage in investing as investing with borrowed money. So if you have $1 million and you borrow $2 million and invest that, you amplify gains and losses. So when times are really good, gains are great when you use leverage, but it could also work against you as well. And in Leopold's case, when the AI stocks fell, his lenders demanded that he put up more cash, which is what we call a margin call in our industry. And he couldn't do it quickly enough, so he was forced to sell stocks at depressed prices to repay the borrowed money, which turned a temporary decline into a much larger loss. And Wall Street often refers to this as like a forced liquidation spiral. So what happens is stock prices decline, margin calls arrive. So Leopold was forced to put up more cash, so raise more money, or sell stocks so that the collateral stayed at the level that the lenders told him to stay at. And then the fund sold assets because they weren't raising cash. Those sales of those stocks pushed prices even lower. And then lower prices trigger even more margin calls, and the cycle just repeats and repeats itself. And Matt and I have talked about this a couple of instances over the past couple of years. This has happened on the podcast before. So it's just a reminder or an example that sometimes investors aren't, or professional money managers aren't selling because they want to. They are because they have to if they're using leverage. And so as this liquidation of these securities unfolded to meet the collateral requirements for Leopold, Citadel, which is Ken Griffin's investment firm, stepped in and purchased most of the fund's public equity portfolio through what we call a negotiated block trade. Rather than allowing millions and millions of shares to flood the open market, Citadel was able to buy positions directly, which helped stabilize the selling pressure instead of letting that bleed into the general market. So I just wanted to bring this up because I think there's several key takeaways that investors can learn from here. And the first is that having the right investment thesis is not the only thing that matters when it comes to the markets. You have to be able to be in the game long enough to survive and see the thesis play out. And second, leverage obviously is a double-edged sword. It can dramatically increase returns when times are good, but it could also force you to sell investments that you might not necessarily want to, or it isn't part of your investment strategy just because your lender demands that you have a certain amount of collateral in the account. So I just think it's a great reminder that, investing risk management is every bit as important as stock selection. And it's not the sexiest thing to talk about, but that's why we put so much emphasis on risk management when we talk about investments in client portfolios. So now that we got that out of the way, hopefully that makes a little bit more sense to people if you've heard it on the news over the past week. We'll go ahead and move into some tweets, articles, and research from this week. First thing I had was a post on X from Freddie Mac showing the current mortgage rates on July 30th. So this was as of the end of July. 30-year fixed mortgage rates increased to 6.66%, which is the highest level in a year. And a 15-year fixed rate mortgage climbed up to 6.04%. So we saw this short-term downtrend in mortgage rates really from August of last year through, I would say, early March of this year. But since early March, rates have been on the rise again, which is not surprising. Inflation is becoming a concern again. The 10-year yield for U.S. Treasury bonds has been on the rise over the past couple of months, so it just makes sense that mortgage rates are increasing too. And Matt and I talked a little bit about this last week, but it's an interesting situation that I think that is unfolding right now, is that you have rising mortgage rates, but you have an increasing level of supply in the housing market in a lot of popular states right now. So it's going to be interesting to see how this plays out. And again, just continue to feel bad for first-time home buyers that they're not catching much of a break right now. Second thing I had was a post from Ryan Dietrich, also on X. This was on July 31st. One of my negative pieces for this episode. So this chart shows the performance of the S&P 500 for the rest of the year after June and July were both negative, which is what happened this year, going all the way back to 1950. So Jenna will throw this chart up on the YouTube page. It'll also be in our show notes. It'll show all of the instances of 2 consecutive down months for June and July, going all the way back to 1950. It'll show you the corresponding forward return for the S&P 500 for the rest of the year, and the results aren't great. Markets have only been higher about 33% of the time. There are a few outliers out there. So in 2008, the rest of the year was negative about 29% after a down June and July. But most of the other years have been just marginally to slightly down. So even if that were to occur, if the S&P 500 is off 2 or 3% between now and the end of the year, it would still be an above average year for stocks, and I think investors would be pretty happy with that. But again, just wanted to point out that we don't always have positive things about the market to say on this show. Next was a post on X from Peter Maluk on July 27th. So just wanted to check back in on the SpaceX IPO, since that was a very hot topic several weeks ago when it IPO'd. Wanted to see how it's going since we last brought it up. And we cautioned that IPOs can be very volatile. And even if you think, it's a good company, the stock could still struggle in its early trading days. And that's actually exactly what happened with SpaceX. So Peter kind of put some stats to it from some data from Charlie Bilello. This chart will be on the YouTube page. It'll be in our show notes as well. He says, history doesn't repeat itself, but it often rhymes. SpaceX may be unique, but the pattern isn't. Euphoric debt, lofty expectations, and a painful reality check. A reminder for investors not to chase hot IPOs. So what it does is it shows popular IPOs in the last 15 years. It shows the 1-year price return, and the max drawdown in its first year of trading. So from the peak to the trough, how much was it down at any point during its first trading year? As you can see, SpaceX is down about 29% from its IPO date. It was down 31% at one point in time. But as you can see, for a lot of these IPOs that have happened over the past several years, we've seen similar instances. So Coinbase, for example, was down 55% in its first year. SoFi down 69% in its first year. Alibaba down 30% in its first year. So we see this over and over again of these really exciting new companies that are coming to market that people can't wait to invest in. Again, that's why I'm always a fan of waiting at least a year, maybe even more, to watch how these stocks trade, because again, just because you think it's a good company doesn't always mean it's going to be a great stock, especially in the early years of trading. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock. Lastly, I want to talk about credit spreads a little bit, and this was from a blog post by Duality Research on July 27th titled "The Fed Hike That Could Save the Rally." So I just wanted to read a short snippet from the blog post that talks about credit spreads and what that means for investors. But before we get into that article, just want to explain for maybe new listeners what credit spreads are and why They're important for investors in the stock market. So a credit spread is just exactly what it says. It's the spread between two different types of bonds, right? So it's the extra interest earned, the extra interest a borrower has to pay compared to a safe borrower like the U.S. government for the same loan length. So, for example, if you have a government bond that's paying 4% and a riskier publicly trading company that has a bond that pays 7%, the credit spread is 3%, 7% minus the, quote, guaranteed rate of return of 4% from government paper. And the riskier the borrower, the wider that spread is. So when companies go to offer debt to the public, they need to set the interest rate according to the risk associated with holding that debt, right? So if there is a company that is saddled with debt, its earnings aren't great, revenue growth isn't great, the fundamentals of the company are weak, they typically have to offer investors a higher interest rate when they're offering debt compared to a quote-unquote safe U.S. government bond. And widening spreads is somewhat of a warning sign. So when spreads grow, it usually means investors are scared about companies' ability to repay the debt. So those companies have to offer higher yields to entice investors to buy that debt. On the other side of things, narrowing spreads show investor confidence. So when spreads shrink, it suggests investors feel pretty good about the economy and the company's health. So in a perfect world, we would rather see tighter credit spreads. And you can kind of think of credit spreads as another fear gauge for the economy. So when that gap gets bigger, markets are a little worried. And when it shrinks, markets are calmer and more optimistic. So now on to this post from Duality Research. They say, unsurprisingly, credit spreads have already started to widen, reflecting this potential shift in market dynamics. That said, it's important to keep things in perspective. Both high yield and investment grade spreads remain in a healthy spot for now, but the direction of travel is worth watching, as it signals growing discomfort with the uncertainty surrounding the Fed and what comes next. And they have a chart that Jenna will throw up on the YouTube page that shows the high yield credit spreads and the investment grade credit spreads. All that means is it's the high yield interest rate compared to what you can get on a government bond, and then the investment grade interest rate compared to what you can get on a government bond. And you can see really since June, they've been steadily rising. Although they're not near levels that we saw earlier in March this year or in March of 2025, where we had, the Liberation Day tariff situation. So just something to watch. It was a really good article that talks about a few other things with the Fed if you want to go and check that out. But it is something that we definitely keep an eye on when things are going a little crazy in the geopolitical sphere. So that's it for today. We will be back for episode 363 next week. Hope everyone has a great weekend, and thank you for listening.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.